Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you trading levels in the major market indexes for the upcoming week of July 1st, 2024. We're going to take a look at the SPY, the triple Qs, the IWM, as well as the bonds as represented by the TLT ETF. Before I get going, the usual disclaimer, Precision Trading Labs, we are neither money managers nor financial advisors. Nothing here is to be construed as investment advice, and everything here is done for educational and informational purposes only for our subscribers. So let's take a look at the charts here. So here is the SPY. We are now coming off of yet another 52-week as well as all-time high. We're sitting at around 544. The high was at 550. So we're basically about 1% off of the all-time high. In terms of potential trading levels, we're looking at the daily chart here. And if we notice right here, we had this point of consolidation here where price rallied up here, then kind of goes sideways here. And then if you notice right there, there is a very energetic bullish candle here, a gap, and then it pops from there. Within this area of consolidation, which went on basically for a week, price more or less was holding within this relatively narrow range. And if we think of the shares that are acquired by willing buyers, we can think of that as demand. And we can think of the shares that are offered up by willing sellers, and that supply of shares that the sellers provide. We can think of that as supply. And so within here, supply and demand are in balance. Okay. And then right here, supply and demand go out of balance because all of a sudden, right within here, there is an exhaustion of sellers. No one is left, no one is willing to sell it within this range anymore. And so left in its wake, where supply and demand were in balance, once price rockets out of there, there is no longer supply. As a result, in its wake, all you have left is demand. And so we think of this now as a demand zone. And so when price returns to this demand zone, we expect, in fact, because price was in here for a relatively short amount of time, that there is still some residual price pressure in here that's waiting to be tapped. And so when price gets back in here, we anticipate another bounce. And this is where we would express a bullish trade at around the 534.5 mark here. So if we get a pullback from, let's say, 544, about 10 points down, this is where we would express a bullish trade. And the simplest way, of course, to express a bullish trade there in anticipation of a bounce would of course, be to buy the SPY. But the other thing one could, of course, do would be to buy a call. And another thing that one could do would be to sell a bull put vertical credit spread, vertical credit spread, and that would be a way of collecting premium. But in all three cases, one could express that trade and you would use the same entry point at around 534 and 70. So that's the principle of what the foundation of our trades are here. And you can see right here, we're about a little less than 2% above there. So if we get about a 2% pullback here, this where we would express a bullish trade here. If that level would fail to hold, then the next level down is about a little more than 1% down, and that's about 3% down. And this is another demand zone that's right here. Okay, so that's the story with the SPY. Okay, if we move on to the triple Qs, which of course is the ETF of the Nasdaq 100, this is where we are now sitting right here. Okay, and we can see more or less the same two formations that I just showed you on the SPY. We're looking at the same formations here on the Qs. You'll notice, though, that the distances above here are obviously different. Okay, before where this was about 3% down and that was about 1.5% down, you can see both of these distances on a percentage basis are about pretty much twice. So the odds are either the Qs or the SPY will kind of call the shots on this. But of course, it'll remain to see which one, in fact, will actually kind of call the tune there. So we'll have to wait to see when we get if and when we get a pullback, which one we're going to follow there. But on the triple Qs, that demand zone here is about 3% down, and then of course on the and then the low one that's lower is about 5.5% down. Okay, in both cases, right now all we have are demand zones in terms of getting a potential bounce. I don't actually have a supply zone to show you because again we're sitting at all-time highs. However, if we now move to the IWM, which of course is the ETF of the Russell 2000, I'll now be able to show you a supply zone here because we're not sitting, we're a bit distant from all-time highs, and so as a result, we can actually now show you a supply zone here. Okay, so right here on the daily chart here, we have this rally-based drop formation, and the same discussion, same thing that I told you about the demand zone is the same thing up here, except turned on its head. In this particular case, we have an exhaustion of buyers here. Right here, supply and demand were in balance here, okay? And then right here, we had an exhaustion of buyers. So right here, there was left in its wake people that were willing to sell, but nobody was willing to buy here anymore. And so as a result, left in its wake is what we refer to as a supply zone. And so when price returns to the supply zone, this is where we would anticipate that there is some selling pressure that's waiting to be tapped. Unlike what I showed you before with the demand zone, which involved buying pressure, this would involve selling pressure here. At this point, where now supply and demand are out of balance, and all you have left up here is supply. So this is where we would express a bearish trade. And of course, the one could short the IWM here, and the other way, of course, would be to buy a put. And of course, if one wanted to sell premium, collect premium, one could, of course, execute a bear call vertical credit spread, and then that would be a way of collecting premium up here. But again, in all three cases, one would execute that trade at the front line of this supply zone, which is 208. Okay, and in terms of how we would structure a trade, though, this would be our entry point at around 208. Okay, but then what we would do in terms of structuring the trade, in terms of its risk management, is this is where our entry would be. We would place our stop a bit above the back line of the supply zone. Okay, and then right here, these lines here represent units of risk here. Okay, so if let's just say if our top line here with the stop is at around 210. Okay, then each one of these represents 1 unit of risk. Okay, so that would be a 1-to-1 trade right here. That would be a 2-to-1 trade. That would be a 3-to-1 trade. Okay, so that's how we would. Now that's how we would manage the trade in terms of risk and reward, and that's where our stop out would be, if in fact that's how we executed this trade. So we can see that supply zone there is about 2.5% above where we are now with that rally-based drop formation here, which is the supply zone. Right here we have an area which is the exhaustion of the exhaustion of sellers that I showed you before. Okay, and we could see that, clearly in the demand zone, and then also I used a 2-hour chart just to refine where this front line would be, and we could see that's a little over 3% down. Okay, so with 2.5% above, we have a bearish opportunity for a trade, and a little over 3% down, we have a bullish opportunity for a trade, anticipating a bounce from that demand zone there. All right, so that's the story with the IWM, and then lastly, we'll finish off by taking a look at the TLT. The TLT, of course, is the ETF of the longer-term bonds, 20 years and beyond. So consequently, this does not take into account the 10-year note. Having said that, the bonds generally tend to more or less kind of move together. And so while the chart of the 20-year and the 10-year or the 30-year, while they're not identical, as the expression goes, they rhyme. And so this is the story here, though, with the TLT. So right here is our close. Right here at around 91.8. Okay, so right up here we have a rally-based drop formation here. Okay, this is the area again where supply and demand go out of balance here. Right here we have a rally. Price base is up there, and then notice that very, very angry bearish candle that drops out of there. So within here, supply and demand were in balance, and then of course it goes out of balance here, and so there's an exhaustion of buyers here, and so this is where we would anticipate another round of selling to occur. Okay, so right here, that supply zone is about a little over 1.5% up, and then less than 1% down here. There is a demand zone here. Also, if you notice on this demand zone here, this is actually, we would tend to think this will be a high probability trade here, because number one, we have a demand zone here, but then over here, this pale blue green line, that represents the daily lower Bollinger Band, the two standard deviation Bollinger Band. So that acts as a backstop for this demand zone here. And then you'll also notice this blue line there, or that blue curve. That's the 50-day simple moving average. So essentially, at this demand zone here, you've got a confluence of this price action pattern here, the 50-day moving average, and the lower Bollinger Band. All three of those things combine to as odds enhancers, and so those essentially act as kind of backstops and odds enhancers for this demand zone. So we tend to think that this would be a high probability trade here if price drops to there. So that demand zone is sitting there at around 91.6, and so again, one could of course again execute a bullish trade there. So we could obviously buy the TLT, buy a call, and of course again sell a credit spread involving puts. All right. And in terms of how that trade would look, as I showed you on the IWM, this is, of course, the inverse of that, since it's a demand zone. So our front line, of course, would be sitting right there. Our back line would be there. And again, there's a 1-to-1 trade, 2-to-1 trade, 3-to-1 trade. Okay. So that's how we would structure all of that. So at any rate, that's what I got. Thank you very much for the privilege of your time, and I will see you next time.